We're going to start off with some emails I got from Sam today. Sam's usually in the room with us, and he offers his insights into different trading strategies, what he's doing as well. And Sam told me this morning that Apple dropped to 360, low 357. 2 trades on it right now. Looks like one bull call or bull put credit spread, the 280, 277.5 strike for $1.55 credit, and that's expiring out to August, the first week of August as well. This week's trade was a 345, 342.5 credit, bull put credit spread, 38 cents, expired today. Apple ended up, I believe, at 353. So he's looking to maybe take profits early in that case, but held it to the end for the full profit. And then he went on to say, tell your students to choose a strong stock like Apple or Microsoft and do the 3-day trades, but have to watch not slip away. Sam was opening these positions possibly on Wednesday for today's expiration, of course not including the one that expires first week of August. And there are some investors I have that I talk to on a regular basis. Let me just move on there. He said at the end of the day that Apple closes at 353. Spread was out 0, short put is 10 points away at that 345 strike. Well, Sam, thank you for that. Sam also says, I hope everyone in the room is doing well. He had just sent in the first comment as well. 10 contracts was a mistake. Credit was 150. Okay. All right, Sam, good. So what I was going to say on that is that I do have Investors Night, a coaching session, and we had a discussion last week about a gentleman that just wanted to trade spreads or just wanted to trade positions on SPY. And I had an email with another customer who was talking about a 1-week spread on SPY he heard about using a delta of around 0.46 and just a 1-point spread on SPY going Wednesday to Wednesday. And I did some back testing on that, and I didn't like what I was seeing originally in that question. But anyway, thanks for that, Sam. And before we go to our next question, I don't know if they're in the room, but my sincerest apologies to Jeremy from last week, Robert, Jeremy, Frank, Bill, and Octavio. Something happened with the second half of our recording, and it was pretty glitchy. So I've had to go back, instead of cropping all the pieces together and putting up the remaining 2 15 to 20-minute webinars we had from last week. The first 2 were already posted. These other 2 segments didn't process correctly. I had to make some changes and go back to the original file. So I will have those for you hopefully first thing tomorrow morning or later tonight if I get a chance to work on them after the children go to bed. So to Jeremy, to Robert, Frank, Octavio, Bill, and William from last week, the end part of last week, I'll get those webinars up to you real soon. I was really trying today, but by 2:30 it was still not processing correctly. All right. But we are recording this presentation. It will be available. And our first real question via email, I see about 4 or 5 other questions have come in. We'll get to those right away. Amin says, I want to trade covered calls on TQQ and UPro. And the questions are, what is the idea delta I should look for to determine the strike price? And is it better to trade ITM or OTM? Well, the first question is going to answer the second question naturally. And what duration is ideal? Okay, now we're going to use the option chain on Power Options to analyze this. The real answer, I mean, is that there is no one answer. It's got to come down to your expectations and your risk-reward tolerance. But there are strong guidelines that we can use to help you figure out which covered call on those positions might suit your needs the best. Okay, so let's get over to, oops, sorry, I don't want both screens there. That's the one I want. I want to pull up Power Options. So here we are at Power Options, and what we're looking at, of course, is the basic 14-day free trial. And those of you that are just getting started, I encourage you to take advantage of the 4 steps that are listed here. You want to make sure, that, of course, that you go through the quick start guide if you're just starting out. And you can go through some of the tutorials if you support Flash. We're taking care of that right now as well. You can access our archived webinars under the free webinars section or join us for our live presentations. And of course, any trial member subscriber can schedule that free coaching session at any time. So just click on free coaching and that will pull up a window for you, a scheduler I should say, where you can simply choose which time slot that you want for, that doesn't look right, Monday, Tuesday, Wednesday, or Thursday. The reason I said this doesn't look right is I thought that I already have a 10 and 11 scheduled for Monday the 29th, but apparently it's showing in, oh, Ernie's available at 11. That's why. This isn't my page. This is the trial page. Sorry, folks. Okay, so you can just pick a time, and it's usually about a 45-minute phone conversation. All right, Amin, let's start off with TQQQ. And I'm basically just going to go to the option chain, and we're going to go to the call chain. And one of the reasons why I'm going to the call chain, let me clean this up a little bit, make it a little bit more crisp without all the added columns for implied volatility ranges, all stuff that you can add. But I'm going to go to add remove columns here, and we're going to just make this a simpler view. Why am I going to the option chain here? Well, the reason why, sorry folks, reset to defaults, submit and save, is because our chain will show you the important returns that an investor would use for a covered call. The downside protection, the percent if assigned as a covered call, and the percent if unchanged. Okay? The downside protection is the option premium divided by the stock price. Shows you how far the stock can drop before you're technically losing money on the position. If you hover over the column, you get the distinct pop-up there with the definition. Percent if unchanged, if the stock doesn't move, what is your expected return? And of course, the percent if assigned, if the stock's trading above your price, what will the return be? Naturally, the percent if unchanged for an in-the-money covered call is equal to the percent if assigned. So you might not need the percent if unchanged, but it is there for analysis as well. Now, I'm going to go out to July 2nd. I'm going to place a hold on that over here and also select July 10th. Okay? Now, my delta column, here it is. I mean, I hope you can see this. Am I on a small chain? Yes, I am on the small chain. Okay, so we've got a lot of 50-cent strike prices here, and this is probably where you're getting confused. This is our delta column here, and these, of course, are our return columns up here. The naked yield is if you're selling it as a naked call. We're not doing that. Now, the first thing we want to notice is that a good in-the-money covered call, we're at 89.48. So let's go 4 points in the money, roughly. 2% in the money, and maybe a little bit less than that. But let's look at the 85.50 strike. Okay, so we're 4 points in the money, and for the 1 week out option, we've got a premium of about 680 at midpoint. Delta is at 0.68. We get a strong downside protection of 7.6%. The stock would have to fall 7.6% before you start losing money on the position. And you still have a reasonable, very strong percent if assigned due to the higher volatility of 3.4%. So you have some protection, almost 8% downside protection with a 3.4% return. And this is for a 6-day trade, so that's pretty strong. You could go up to the 9 and 10% downside protection range going deeper in the money and still get a 2.5% return, which is kind of phenomenal for a 1 week out trade. That, again, is due to the high implied volatility of these 2 times ETFs in this case. Now, going further out of the money with a lower delta, we see the opposite. So if I go 4 points out of the money up to 93.50, right here, we're taking in about 240, 239. Delta of 0.37. We're kind of reversing it. Now we're only getting a 2.7% downside protection for lower premium, but a potential 7.4% return if assigned. But that's if and only if the stock's above 93.50. Otherwise, we still have a 2.7% yield or unchanged against the position. So, I mean, to answer your question first, all these chains are going to look the same, meaning that as you go deeper in the money, naturally you get the higher downside protection with still getting a strong return. Out of the money, you're taking in less premiums, so you have lower protection, a potentially higher percent return, maximum, but you also have a lower probability of seeing that max return. So what is your trading plan? Are you looking to be conservative, realizing you're in a 2 times ETF and that the market is, maybe we could say, a little unstable right now? It's being a little bit difficult this week, the last few days, but we expected ups and downs, didn't we, during this time? So if you wanted to be more conservative, you'd probably focus in the money. Higher deltas, maybe above 0.65 to maybe 0.8, somewhere in that range, where you can get an 8, 7, 9, 10% downside protection with still seeing a 2.5, 3.4% return, and that's for a 1 week out trade. If you're more speculative, you don't want to be assigned on TQQQ, you're hoping to just hold it and sell week after week or every 2 weeks against it, you may be considering the out of the money just to get some premium, hope the call expires worthless, and then you continue to write it later on. In Ernie's testing, when we go to the covered call picks of the day, so here, the covered call, he created the monthly picks of the day and the weekly picks of the day. These are searches that he created after doing varieties of different tests, different criteria, different time frames, and so forth. And what he found out is the positions that give the best return are slightly in the money for more consistent return over time. So that when you do have some losses, it might wait out, when the stocks pull back, you may see some losses that might wipe out some of the smaller gains from the in-the-money covered call return. But if you're already starting off in the money, the stock has to fall a good 4, 5, or 6% before it's not assigned. So you tend to get a higher expectation of assignment and the maximum profit, even though it's lower. At the money would have worked pretty well in some markets, such as maybe 2017, but then in 2018, what happened? 6 out of the 12 months were actually negative market performance. So it's safer to be in the money covered calls in a year like that. Yes, if I did out of the money, you can look back and say, oh, for the beginning of January 2019 and the beginning of January 2018, before the market hit with the trade wars in February of 2018, or even at the beginning of this year from January to February, you could speculate that the out-of-the-money calls were probably more successful return-wise because there's a lot of growth still going on. The stocks were moving up to that price and getting assigned. But taking into account the last few months, an in-the-money covered call approach would have not probably made money after March, but it would have helped you retain more money and not see as much losses with the smaller premiums for selling out of the money covered call positions. Okay, so in the direct answer to your question, is it better to trade in the money or out of the money? Well, that depends on your goals. If you want to hold the stock or this underlying longer term and you're just looking to generate $2, $3, $4 against it every week or every 2 weeks, it's okay to be out of the money. Just remember you're taking a lot lower downside protection and you shouldn't expect to see the maximum return if assigned on a regular basis. If you're not married to these positions and you don't mind going in every week or every 2 weeks or so, then of course you'd want to go in the money for that higher downside protection and still get a good 2, 2.5, 3% return if assigned on these positions. For your other question, what duration is ideal? And I'd mentioned that Ernie found that long-term covered calls slightly in the money perform better in different market conditions than the at the money and the slightly out of the money. Also in that note, the weekly picks of the day, Ernie found that he could get good returns going 5 to 7 days out, opening a position on Monday for the following Friday expiration. And so as you know, when you're selling covered calls, you're selling any premium, going shorter term will give you a better annualized return. Going twice the amount of time out, and that's why I went to the 2-week out series here. We talked about that 85.50. Oh, it doesn't have the 85.50 strike. That's odd. But the 85 strike here you see is at 8.95 for 14 days out with a 10% downside and a 5.6% return. The 85 strike here, 7.13, 8% downside, 3.2%. What I'm showing you here is that when you go twice the amount of time out in time, you don't double the cost. The option that's 6 months out in time is not 6 times the cost of the regular standard expiration. You get a better annualized return selling week by week by week if the premium, protection, and return matches your goals. And in this case it would because the IV is so high. If I was doing a covered call on KHC, Kraft for example, with a much lower volatility, a 1 week out in the money or slightly out of the money call might not be giving me enough premium to match my protection goals or my standard goals. I might need to go 2 weeks out or 3 weeks out. Okay, so I brought the 2-week one up because I mentioned Ernie's testing with the covered calls, and he's got the weekly picks of the day there for the covered call positions. In my testing for bull put credit spreads, which I did something similar, and actual testing, of course, actual trading, excuse me, and testing, what I found was that going 2 weeks out in time gave a better performance over time. That I was able to get a higher overall return because when I tried to force bull put credit spreads only 1 week out in time, Sam can watch his screens more. He had mentioned the 3 days out in time in that case and was doing pretty well. But comparative testing showed that when you factor in the wins and the losses, even if you're controlling your losses to a smaller point, over different market periods, different years of testing, the 2-week out bull put spreads with a high probability performed better than the 1-week out spreads. Okay, so I would say you're okay 1 to 2 weeks out with this higher volatility. Delta, what would you look for? Well, it's not really so much about delta to me, it's about the numbers. What is your trading goals for return and what protection best suits your outlook for the market, your personal fear gauge for the market of how much protection do you want on the position while still hitting your target. Eventually you'll be able to see, based on that, what delta you're kind of targeting. I think it's best to look at the return and the downside protection to meet your goals first, then worry about what delta. And again, I'm just suggesting in the money based on an expectation of continuing to trade, not being married to the position if you want to buy it back the next week and do another covered call. But if you want to hold it long term and you're trying not to be assigned, then yes, you would go ahead out there, look further out of the money. Okay, let's see here. All right. I wanted to go down here to see some of the comments. Sam said TQQ is a triple leverage. Options are elevated price. Yeah, it's the Ultra Pro TQQQ. It's the Ultra Pro QETF. I thought it was a double there, Sam. Sam's saying it is a triple. Okay, all right. And I know there's a lot of questions here from Craig, from John. Let's see. Sam, there's your other comment I was looking for. You bought TQQ at 50 but did not sell 100 shares at 50 price. You sold 100 calls to make a covered call on Tuesday. So Sam went very far out of the money as well. Okay. All right. And Rashab, I see your question too. I'm just going through this here. Okay, Richard. Oh, okay. Thank you. Guillaume says those are actually the 3 times. All right. Sorry about that. Yeah. So the 3 times there. And Sam says expect the market to be volatile as well. Also, okay. Sam says TQQ is below 100 MA. Next level is 200 MA. Might see a bounce there if it drops below that price. Okay.